Tired of dropping your phone or struggling to prop it up? Meet the Pop Sockets phone grip with expanding kickstand in black, your new must-have accessory. Don't miss out. Grab yours today. Click the link in the video description to shop now on Amazon.
Welcome to Electro Drive News. I'm your host, and today we're talking about a concerning trend in Europe's corporate car market. Germany, one of the largest automotive markets in the EU, is actually pushing companies towards polluting SUVs instead of electric cars. But why? Well, it all comes down to tax incentives. In fact, Germany offers one of the smallest tax gaps in favor of electric company cars. The difference in taxes that companies pay for a petrol car compared to an electric vehicle over 4 years is almost 9,000 euros less. Now, compare that to France, where the gap is more than 24,000 euros. This might seem like a small difference, but it's actually a crucial incentive to accelerate demand for EVs. The EU's largest automotive markets, Germany, France, Italy, Spain, and Poland, account for 71% of corporate car sales in the EU, which makes them really important when it comes to electrification. But unfortunately, only France is creating effective incentives for the purchase of electric company cars. In contrast, countries like Spain, Italy, and Poland are failing to significantly incentivize electrification. This isn't just about tax gaps, it's also about the type of vehicles being sold. Large polluting SUVs are becoming increasingly popular in Europe, with 40% of heavier combustion SUV company cars ending up on the German market. Meanwhile, France is penalizing these big polluters a lot, accounting for only 0.3% of these SUVs. So, what's going on here? Well, it all comes down to tax policies. Company car taxation in Germany is actually driving the trend towards large SUVs. The country offers VAT deductions and depreciation write-offs that make companies more likely to buy combustion engines over electric vehicles. This is a big problem because it means companies are getting more benefits than they're paying in taxes. T&E, an environmental organization, has been looking at company car taxation policies across Europe, and their findings are alarming. They found that only France, Portugal, and Slovenia have much greener fiscal systems, taxing company cars based on their CO2 emissions and weight. Germany is one of 7 EU countries with no acquisition tax for petrol cars yet. Now, the director of T&E's electric fleets, Stef Cornelis, has a strong message. Many governments in Europe, especially big countries like Germany, have a tax policy that is bad for climate, bad for the automotive industry, and gives rich drivers more benefits for polluting. The solution is simple. Governments should tax cars on how much they pollute and take up. This will generate revenue and boost demand for electric vehicles. It's not just about government policies. Car makers also need to play their role in this debate. Stef says, "You cannot complain about lack of demand, ask the European Commission to weaken your targets, and at the same time, refuse green tax reforms or push back against the European Commission's plans to accelerate electrification of company car fleets." So, what can we do? First, governments need to rethink their tax policies. They should be creating incentives for electric vehicles, not polluting SUVs. And car makers need to step up and support these changes. For now, it looks like France is still the leader when it comes to green taxation policies in the EU. If other countries follow suit, we might see a significant shift towards more environmentally friendly company cars. But until then, companies are likely to keep pushing polluting SUVs, at least for now. That's all for today on Electro Drive News. Thanks for watching.